Hello, this is Asa Graves, Chief Investment Officer at Graves Light Lenhart Wealth. In this update, we highlight the likely impacts of the current tariffs on economic debt and securities markets, along with implications for portfolio positioning. This communication is not only meant to lay out our current thinking, but to engender discussions with our clients. For those of you who wish to study this presentation in more detail, we have provided a link in the message sent to clients to access and download the slides for further analysis. As always, please let us know how we can help you. The current fundamental economic and financial market indicators are in a state of flux, and we believe it'll take some time before the picture clears. We appreciate that this may not be comforting, but properly diversified portfolios have helped investors weather such storms in the past. In times of uncertainty, there is a natural human desire to do something. This impulse has been termed the illusion of control bias, which often leads to poor long-term results. Markets largely churned over the past 2 quarters and broke decisively to the downside once the implementation of tariffs was officially announced. In our opinion, the longer tariffs are left in place, the odds of recession increase dramatically. Nonetheless, our current stance is more in line with Jack Bogle's admonition, "Don't do something, stand there," and resist the emotional impulse to react to markets. This slide shows asset class return data over the past 2 quarters. The left pane shows returns during the December 2024 quarter. Return data for the recently completed March 2025 quarter are in the middle, and the overall 6-month period returns are on the right. Essentially, many asset classes during the March quarter moved in inverse performance patterns relative to their behavior in the December quarter, resulting in flattish to slightly negative performance over the entire 6-month period, as represented by the traditional 60% stock, 40% bond asset allocation blend highlighted by the blue bracket. Market volatility exploded with the official announcement of tariff implementations in early April, but market indecision had been building for some time. Given the recent news flow, it is obvious that no one knows how long the announced tariffs will be in place, or consistent effective levels applied to various countries or product areas. Therefore, it is extremely difficult to estimate their impact on future economic conditions. Nonetheless, we believe tariffs will retard future growth and pressure inflation higher, at least over the next year or so. U.S. economic growth appears to have meaningfully downshifted prior to the implementation of these tariffs. If the added burden from tariffs pushes the economy into recession, we need to be prepared to accept that the maximum drop experienced so far by the S&P 500 from its February 19th all-time high may only account for roughly half of the recession-related average declines experienced in the past. The chart on the right of the page shows the range of historical asset class returns over various time frames. Part of successful long-term investing is accepting that markets can experience a wide range of returns over a 12-month period. Our goal is to keep clients properly allocated over longer periods, which have shown a high propensity to achieve significant positive returns, dwarfing the few adverse outcomes of small declines or break-even results over various longer time frames. The key is time in the market, not timing the market. Diversification can be a great way to deal with uncertainty. We refer to this chart as the asset allocation quilt. The columns represent annual returns starting in 2010 on the left, moving across to 2024 on the right-hand side. The various asset classes are represented by color-coded squares. Scanning the entire time frame shows the random performance lineups of the various asset classes for a given year. Yet the white box representing diversified asset portfolios largely falls in the middle of the asset pack, as highlighted by the black line linking the annual returns. We believe that limiting the risk from any one asset class is one of the more reliable strategies to tackle increasingly uncertain conditions over time. Tariffs largely function as a sales tax. As such, much of the tariff cost is often borne by the end consumer. The impact of a tariff is largely dependent upon the rate and time period implemented. As evidenced over the last few days, it's hard to get a firm handle on either of those variables. Analysis by respected economic forecasting firms point to inflation rising to the 4% range by the end of the year and then moderating lower. Higher inflation is not a positive, but we do not think inflation will snap back to the levels reached during the ugly periods of the past. Stagflation occurs when the economy slows and inflation increases, which is not a recipe for healthy future economic growth nor security prices. However, like most things in life, unfavorable conditions must reach a certain level before causing major damage. The misery index is a useful measure of stagflation by incorporating both unemployment and the inflation rate. The most current reading from February shows that the misery index is well within the range of the past few decades. We expect both unemployment and inflation to increase under sustained tariffs. However, we do not foresee levels increasing to the dark days of the 1970s when the misery index rose well into the double digits and securities prices struggled. The performance of small caps has been frustrating. The chart on the upper left shows the S&P 600 small cap index, represented by the purple line, compared to the S&P 500, the red line, from the presidential election in November through April 11th. Small caps initially experienced strong outperformance in the days following the election, but began to meaningfully underperform in early December, even though earnings per share estimates remained solid and pointed to attractive valuations. The chart on the lower left shows that small cap performance, again shown by the purple line, has achieved strong relative performance versus the S&P 500 during much of the past 20 years, and the stark underperformance during the past few years may provide an attractive long-term opportunity. Going forward, it is important to point out that small caps have outperformed during certain recessions and the ensuing rebounds in the past. In summary, we believe small caps provide a much better relative value over the ensuing market cycle, but the ride is unlikely to be a smooth one. International stocks have experienced frustrating relative performance over the past few years, but have performed much better over the past few months. The significant valuation disparity between international and domestic stocks continues to persist across all but one market sector, as shown in the middle chart, with the purple dots representing the current discount versus the historical discounts represented by the gray bars. We believe these unusual discounts offer the opportunity for greater future returns relative to domestic large caps. Furthermore, non-US based stocks can provide portfolio diversification benefits, enhancing their attractiveness. The illustration on the left of the page shows the starting monthly yields for the Bloomberg U.S. Aggregate Index, a key benchmark for U.S. investment-grade bonds, on the horizontal axis since 1976. The vertical axis represents the 5-year annualized return for this index based on the entry yield and shows a reasonably tight relationship between the medium-term returns and the starting yield of this asset class. As of the end of March, the yield for the Bloomberg U.S. Aggregate Index was nearly 4.7%, which has risen towards 5% recently, pointing to annualized 5-year returns of approximately 5%. Increasing interest rates have a negative effect on the principal values of bonds, but we think the risk profile of a total return over the next 12-month period of a loss of 1.5% if interest rates increase another 1% from here to positive 10.7% if interest rates fall 1% provides an important ballast to portfolios. Thank you for your time and interest. Periods of weak markets are never fun, but they can often be the most impactful on long-term returns, which highlights the importance of proactive planning and developing the confidence to make sure the elements of such plans are consistently implemented. We hope you found this information useful and that you're more comfortable with the positioning of your financial assets. As always, please let us know if you wish to discuss these or any other issues. We're here to help.